Wall Street expected Fifth Third Bancorp to lose money in the first quarter of 2026. The consensus estimate was negative 10 cents per share, a loss. What they actually reported, 15 cents profit per share, a 25-cent beat, and on an adjusted basis, removing the one-time merger charges, 83 cents, beating a 62-cent estimate by 34%. I'm Hudson Thomas.
And I'm Lana Chen. The reason analysts expected a loss is because Fifth Third just completed the largest acquisition in its 168-year history, Comerica. Closed February 1st, 2026, a $12.7 billion all-stock deal that made Fifth Third a top 10 U.S. bank for the first time ever.
The merger charges hit just like the Street modeled. $635 million of GAAP drag in one quarter. What they didn't model well enough was how strong the underlying business was. Net interest margin expanded to 330, NII jumped 34% year over year, and the CEO, Timothy Spence, walked to that earnings call and said what every analyst most wanted to hear. There really haven't been any big surprises.
For a deal this size, no surprises is the most bullish thing he could say. Let's dig in.
Fifth Third Bancorp was founded in 1858 in Cincinnati, Ohio, and yes, the name is exactly what you think it is. In 1908, two Cincinnati banks merged, Fifth National Bank and Third National Bank. The resulting institution kept both names, and it stuck for over a century.
Today, that century-old Cincinnati Bank is a 21st-century financial services company with nearly $300 billion in total assets. They operate across 11 states and have 7 major business lines: consumer banking, commercial banking, wealth management, capital markets, payments, and their embedded finance platform called Newline, which competes directly with fintechs.
The Comerica acquisition is the inflection point for this story. Comerica had about $90 billion in assets, a dominant Texas commercial banking franchise, especially in tech, energy, and life sciences, and a California presence that Fifth Third didn't have. Overnight, FITB became a different kind of bank.
What makes Fifth Third strategically interesting is that they're simultaneously playing the traditional regional bank game and the digital banking game. Momentum Banking, their flagship consumer digital product, has over 2.4 million monthly active users. Newline grew fee revenue 53% last year and counts Stripe and Trustly as clients. They're not a bank pretending to be a fintech, they're a bank that built actual fintech infrastructure.
And on top of that, they're opening de novo branches in Texas. 81 of 150 targeted locations have signed letters of intent. They're playing offense while digesting the biggest deal of their life. That takes some confidence. The architect behind all of this is Timothy Spence. He became CEO in July 2022 and chairman in December 2023. But here's what makes him unusual. Before banking, he was a senior partner at Oliver Wyman, one of the world's top financial services strategy consulting firms. He joined Fifth Third as chief strategy officer in 2015.
That consulting background shows. Spence runs Fifth Third more like a tech-enabled platform business than a traditional bank. He was named American Banker's Digital Banker of the Year in 2018 while he was still strategy chief. Momentum Banking, Newline, and the Comerica acquisition all flow from his thesis that regional banks need to compete on capability, not just geography.
His Q1 call tone was carefully confident. He described the Comerica integration as running without surprises, said the bank doesn't need a perfect macro backdrop to deliver, and framed complexity in a way that signaled control. The global economy is a complex adaptive system, and we're planning for multiple scenarios. That's not banker speak for panic. That's an executive who has done the stress testing.
Let's get into the numbers. First, the headline setup. Fifth Third trades at $50.34 per share with a market cap of roughly $44 billion. The trailing PE is about 17 times, but that's noisy because Q1 2026 was dominated by merger charges. The more useful forward multiple. Management's FY 2027 adjusted EPS target is $4.89 per share, which at today's price gives you a 10 times forward PE. That is cheap for a bank executing this well.
Price to book is 1.22 times, right at book value essentially. and the dividend yields 3.1% at the current price of 160 annualized. Share buybacks are on pause until the second half of 2026 while they rebuild capital, but management expects to resume.
On the income side, Q1 2026 net interest income was $1.934 billion, up 34% year over year and up 26% sequentially. A lot of that is Comerica, but Comerica didn't get acquired at a random time. Fifth Third wanted that asset mix because it expands their net interest margin,
which hit 330. 330% net interest margin, that's up 17 basis points from Q4 2025 and 27 basis points from a year ago. Management is guiding toward 340 by year end. Every basis point of NIM on a $200 billion earning asset base is about $2 billion of NII annually. The math on that is significant.
Non-interest income came in $921 million adjusted. Capital markets fees were $134 million. Wealth management fees, $233 million on $119 billion of AUM, and new line embedded finance growing 30% year over year. The fee engine is diversified.
Now the messy part. Non-interest expense adjusted was $1.77 billion. That's the cleaned up number. GAAP includes $635 million in merger-related charges on top of that, which is why the headline looks so ugly. Efficiency ratio adjusted is 61.9%. Still elevated, but that's the CDI amortization, $210 million per year, baked in from the Comerica intangibles. That normalizes over time.
Credit quality, net charge-offs at 37 basis points, a two-year low. Non-performing loans at 54 basis points of total loans, down from 62 basis points last quarter. ACL at 1.79% of loans. Criticized assets improved modestly. For a quarter where they just absorbed $60 billion in new Comerica loans, that credit picture is clean.
Balance sheet, total assets at $297 billion, first time in the bank's history crossing $300 billion. CET1 at 10%, which is the new operating target. Loans at $178 billion, deposits at $231 billion, cash $4.1 billion.
FY 2025 cash generation, operating cash flow $4.5 billion, free cash flow $4.3 billion. The business generates cash at scale. Overall, Fifth Third's financial health is solid. The adjusted core is strong and improving. Credit is clean, and the path to significant earnings leverage via synergies is well articulated, even as the GAAP picture remains complicated by integration charges.
Let's see what Wall Street thinks. 15 analysts cover Fifth Third, 12 have buy or outperform ratings, 3 have holds, and 0 have sells. The average price target is $56.29, implying nearly 12% upside from the current price.
Morgan Stanley is the bull at the table with a $60 target, citing Newline's potential for a valuation re-rating as embedded finance multiples differ from traditional banking. Jefferies also raised their target to 60 before earnings. Goldman Sachs initiated with a buy at 55. JP Morgan raised their target to 53, specifically calling out Comerica deposit retention in the Southwest as ahead of schedule.
The call itself got pointed questions from Piper Sandler's Scott Seifers about underlying margin drivers, and Wells Fargo's Mike Mayo pressed hard on integration risk management and the Texas deposit ramp. Management handled both confidently. The tone on the street is cautiously optimistic. They like the beat. They want to see the next 2 quarters of synergy delivery before getting more aggressive.
The Q1 earnings call saw the stock edge about 2% higher pre-market before settling in. Not a massive euphoric move, more of a calibrated approval. The street is in wait-and-see mode on whether the integration thesis plays out through Labor Day.
Let's do bull case first. The core argument is simple math. $850 million in annual expense synergies at run rate by Q4 2026 is a massive number. At a 20% tax rate, that's $680 million after tax, roughly 76 cents per share added to EPS annually just from cost cuts. Layered on top of organic NII growth, NIM expansion toward 340, and Newline at 30% revenue growth, the FY 2027 489 adjusted EPS target starts to look conservative. And the entry valuation matters here. 10 times forward earnings on a bank this size and quality, with proven management, is historically cheap. If the Comerica integration executes cleanly through Labor Day and Q2 NII lands at $2.2 billion or above, this stock has a clear path to the Morgan Stanley $60 target and beyond.
Now the bear case. That Labor Day system conversion is the single biggest risk in the story. Core banking system migrations at this scale, taking Comerica's Texas and California commercial clients onto Fifth Third's technology stack, have failed at other institutions and caused permanent deposit attrition. If that conversion stumbles, the relationship losses could offset years of synergy delivery. The efficiency ratio is also real, 61.9% adjusted. That's not great. And $210 million of annual CDI amortization suppresses GAAP earnings indefinitely. The stock is also up significantly from its 52-week low of $32.79, so the easy money from the merger announcement has likely been made. The remaining upside requires execution proof across 4 to 6 more quarters.
How does Fifth Third stack up against peers on price to book? That's the standard lens for bank valuation.
Fifth Third is at 1.22 times book, right at the sector median. M&T Bank, ticker MTB, is also at 1.22, but with a NIM of 3.71%, significantly higher than Fifth Third's 3.30. M&T earns its similar multiple with superior net interest margin, so the relative valuation argument runs both ways. Huntington Bancshares trades at a slight premium at 1.31 times, though it has a smaller, more rate-sensitive franchise. Citizens Financial is at 1.11 and KeyCorp below book at 0.92. Both offer more risk and less diversification than FITB.
The interesting comparison is ITB versus M&T, both at 1.22 times book, but M&T has the NIM advantage. Fifth Third has the scale and synergy advantage. If Fifth Third can close the NIM gap toward 340 by year-end, their valuation case versus M&T gets significantly stronger. Quick look at options. Implied volatility in FITB has settled below the 22nd percentile post-earnings. The stock delivered a clean positive surprise, and the integration risk is partially priced out. Put-call ratio near 0.78 reflects a modest bullish lean.
For investors who own FITB or are considering it, the low IV environment could make covered calls on near-term strikes an interesting income generation overlay. There's no large directional options positioning visible that suggests the market sees near-term binary risk.
On insider activity, there are no notable open market purchases or sales filed in recent months. The all-stock Comerica deal means management holds shares subject to lockup restrictions, so the lack of open market activity isn't a negative signal. CEO Spence's compensation is heavily equity-linked. His interests are aligned with the stock price.
The quiet period around a transformational acquisition like this is standard. What matters more is execution, and every quarterly update from here is effectively a real-time insider confidence signal.
The main risks on Fifth Third. First and most critical, Labor Day 2026. That's when the full systems migration happens. Comerica's customers move on to Fifth Third's technology stack. The bank has planned 3 to 4 mock conversions before the actual cutover. But this is the moment of truth. Even a week of disruption in core commercial banking can permanently damage relationships.
Second, macro sensitivity. Fifth Third's guidance assumes rate stability. If the Fed cuts aggressively in response to tariff-induced slowdowns, NIM could compress meaningfully. Their Midwest commercial book, Manufacturing Auto Industrials, also has direct tariff exposure. Management acknowledged the uncertainty but said they're running multiple macro scenarios.
Third, CDI amortization. $210 million annually from Comerica's intangibles suppresses reported efficiency ratio and GAAP earnings through mid-decade. Investors need to track adjusted metrics, but that adds complexity for retail investors who see the GAAP numbers.
And fourth, execution on Texas de novo branches. 81 of 150 branch letters of intent are signed, but signing an LOI and actually building a profitable branch network in Texas with full competitive intensity from JP Morgan, Wells Fargo, and local Texas banks is a different proposition entirely.
Bottom line on Third Bancorp. A century-and-a-half-old Cincinnati bank just became a top 10 U.S. institution overnight with the Comerica acquisition. The first quarter delivered a massive earnings beat against a very low bar, 15 cents gap versus a negative 10-cent estimate, and the adjusted core was even more impressive at 83 cents per share. NIM is expanding, credit quality is improving, and $850 million in annual synergies are loading up.
The key metric to watch is twofold. Q2 NII, does it land at $2.2 billion or above, confirming the NIM trajectory? And Labor Day 2026, does the Comerica Systems migration execute cleanly? Those two data points will determine whether this is a re-rating story or an integration stumble. At 10 times the FY 2027 earnings target, the upside if they deliver is meaningful.
This is a bank that just made the biggest bet in its history. The first quarter suggests it's working. The next 6 months will tell us if it can hold together. We'll close with a quote from Vincent van Gogh. And yes, the painter of Starry Night has something profound to say about bank integrations. He wrote, "Great things are not done by impulse, but by a series of small things brought together."
That is exactly the thesis on Fifth Third right now. $850 million in synergies isn't one dramatic move. It's 1,000 small decisions, renegotiated contracts, closed branches, consolidated technology systems, all brought together one quarter at a time.
That's going to do it for today's episode of Charged Alpha, your guide to the S&P 500, one stock at a time. We covered Fifth Third Bancorp, ticker FITB, Cincinnati's century-old bank, now a top 10 U.S. institution, proving the skeptics wrong one quarter at a time. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.